Hello everybody, this is the part 3 of chapter number 3, Accounting for Materials of ACCA F2 Management Accounting. Before watching this video, make sure that you have watched the part 1 and part 2. In case you haven't, then I've linked it in the description box below. So make sure to also check out the previous chapters. Before starting this video, make sure that you have a calculator, a pen and a paper with you, and you are making notes and solving the questions along with me. So in the previous two parts, we saw the chapter till the economic order quantity, and we have also completed the economic order quantity. Alright. And after that, we had to do the test to understanding number 6. Even though I have discussed this, now I will solve it in detail. So a company is planning to purchase 90,800 units of a particular item in the year ahead. That means this is my annual demand. The item is purchased in boxes each containing 10 units at a price of 200 per box. So 200 is the per box, so unit price is 200. And the item is purchased in a box which has 10 units itself, so it is like a pack. The cost of holding an item for the year is 15% of the purchase price. So that would be 15% of 200. The cost of placing and receiving the orders is where costs of 5910 were incurred on 30 orders. So 30 orders would be 30 boxes, right? So if the cost for 30 boxes is 5910, 30 orders, then what would be the cost of one order? 5910 upon 30, unitary method obviously. So this is very basic. So this would be 197. So cost of placing one order is going to be $197. It should be assumed that ordering costs change in proportion to the number of orders placed. 2% should be added to the above ordering costs to allow for inflation. Alright. Assume that the usage of the items will be even over the year. So they are saying that to my ordering cost I need to add 2% and I need to adjust it for inflation. So when we are talking about inflation, it is always going to be increase in my cost, right? So how am I going to do this? Okay. So first let's find the cost of ordering one item. So the cost of one order would be 197, right? We found this. But we need to add it to the inflation, so that would be 2% more. So what is 2% of 197? 3.94. So I am going to add my inflation rate. So that is 2% on my ordering cost. So I found the ordering cost of 1 unit and then I added the 2% to it. So 197 plus 394 is going to give me 200.94. So 200.94 is my per order price. I hope you got it. So this is my per order price. Moving on. Now let's find the cost of holding one cost. Cost of holding. So it is 15% on purchase price, which is 15% of 200. It is 30. So cost of holding one box is 30. This is the cost of holding one box. So this is my cost of ordering and this is my cost of holding. What is my annual demand? My annual demand is 90,800 per unit. Read the question properly. The company is planning to purchase 90,800 units. But if you see below, they said that boxes of 10 units. So they said that one product will be having 10 units in it. Here they haven't given boxes, they have given units. So in order to find the boxes, I am going to divide 9,800 into boxes. So that would give me 9080 boxes. Okay, I don't need the units, I need the number of boxes. So my annual demand would be 9080. Now how do I find out my economic order quantity? My economic order quantity, you know the formula, right? So let's just put it in the formula. 2 times cost of order 200.94 multiplied by my annual demand, which is 9080, divided by my cost of holding. Let's do this. 2 multiplied by 200.94 multiplied by 9080 divided by 30 under root. So my answer is going to be 348.76. So if I round it off, it is 349 boxes. So that's how you are supposed to approach this question. Now we're starting the new topic, which is quantity discounts. So we are going to discuss about what exactly is quantity discount. So if you can recall, in the previous papers, you have done something called as the bulk discount. So what was bulk discount or trade discount? When a person buys a large quantity of goods, you are given a discount. So this is going to be something just like that. I gave you an idea to just connect with that. So it is often possible to negotiate a quantity discount on a purchase price offered by a supplier if bulk orders are placed. So if I go to the market, if I go to the shop and if I say that I want to buy one chips packet, he'll give me for 30 rupees. If I say I want to buy even 5, he will give me 5 multiplied by 30 rupees. But if I tell him that I want to buy 300 chips packets, he will give me a discount. Why is he going to give me a discount? Because I am buying in bulk. So this is that concept. Okay. So if quantity discount is accepted, this will have the following effects. Annual purchase price will decrease. Obviously, my annual purchase price will decrease if I am getting a discount. Holding cost will increase. Why will my holding cost increase? Because I am purchasing a large quantity of goods. So due to that, my inventory, I will be needing a larger storage space. The annual ordering costs will decrease. Since I'm ordering in bulk, so each time I order, I'm ordering a high quality, so I don't have to repeatedly keep ordering. So due to that, my ordering cost will decrease. Hope that is clear. So now we are going to see how to find the economic order quantity when quantity discounts are available. So do I need to accept the discount or should I not accept the discounts? That is what we're going to look into this. So the steps which are involved in calculating the economic order quantity when quantity discounts are available are as follows. So first we need to, this is something which we'll do practically, but I'll just give you a gist of it. For example, let's say if I buy let's say 10 goods, then they're going to sell them for 10 rupees total. But if I buy 20 goods, they are going to sell them to me at 50 rupees total. Now tell me something. After few days, if I buy 10 again, then I have to pay entire 10. But here, I have to, if I in one time only, if I buy a large quantity, I'm getting 15. So here, this would be rupees 20. Here it is 15. So in a way, I'm getting 5 rupee discount. So now we are going to discuss how do we weigh this, how do we weigh the differences, and how do we evaluate whether or not we need to be taking the discounts or not. So calculate the EOQ ignoring discounts. If the EOQ is smaller than the minimum purchase quantity to obtain bulk discount, calculate the total of the annual inventory, holding costs and everything. So we need to evaluate everything and weigh all the pros and cons before accepting a particular discount. We will see this practically so then you will understand it better. Let's do the illustration. A company uses components at the rate of 500 units per month. 500 units per month, which are bought in at a cost of 1.20 each from the supplier. It costs 20 each time to place an order, regardless of the quantity ordered. So no matter how much quantity you order, even if it's 100 or even if it's 1, either ways you need to pay $20 each time to place an order, regardless of the quantity ordered. The supplier offers a 5% discount on the purchase price. So my purchase price is 1.20. Okay. For order quantities of 2000 items or more, so you will get the discount. You can avail the discount only if you order number of units which is more than 2000. The current economic quantity is 1000 units. So currently your economic quantity is 1000 units. The total holding costs is 20 per annum of the value of inventory held. So now we need to find out whether we need to accept the discount or not. So how am I going to do this? So what is my own economic order quantity? 1000, right? It is 1000. So first I'm going to calculate my economic order quantity with my 1000 units, and I'm also going to of 2000, and then I'm going to see where am I getting a profit. How do we do that? So we are basically going to find my total annual cost in both the situations. The first situation is the discounted quantity. The second situation is my economic order quantity. And after finding both of the total annual cost, I am going to compare both of them and see where am I getting an advantage. So if my total annual cost after accepting the discount is less, then I should definitely take that. But if my total annual cost is more after accepting the discount, then I should not be availing the discount. Very simple. Now let us just do the illustration to understand it better. Okay. So let us first do of 1000. So my economic order quantity is 1000. Let me find my ordering cost. How do you find out your ordering cost? Recall and start solving it, then I will discuss. The answer is literally right in front of you. Okay, so my ordering cost is 20. Cost of placing one order multiplied by my annual demand divided by my economic order quantity, right? So that would be 20 into 500 into 12 divided by 1000. 120. So my ordering cost is 120. Got it? Now I have to find my holding cost. What is my holding cost per unit? My holding cost per unit is 20% on the value of inventory held. So how am I going to find that? Average inventory, order quantity. So what is the holding cost per unit? 1.20. You know that the holding cost is always calculated on the price. So this is going to be 20% on the cost, 20% on the cost multiplied by my average inventory, which is economic order quantity divided by 2. 20 into 1.20 into 1000 divided by 200. So that would give me 120 again. Got it? Now, after finding the total ordering cost and total holding cost, I need to find my purchase cost. What is purchase cost? P into D. That was my formula for total annual cost. So purchase price multiplied by annual demand, which is 1000, right? Again, multiplied by D. That was a mistake. So P is my 1.20 is my purchase price multiplied by annual demand, not quantity, right? Annual demand. What is my annual demand? 500 multiplied by 12. Why am I multiplying it by 12? Because here it is given per month. So that is 1.20 multiplied by 500 multiplied by 12, which is 7,200. If you add them, you will get your total annual cost at 7440. Now the same way, we are going to take my economic order quantity as 2000, and we are going to, instead of using 1000, we are going to just use 2000 and find the order cost, holding cost and my purchase cost. And if we add, you will get 7128. Do it by yourself. Now look at it. If I am ordering only 1000 units, my total annual cost is 7440. But if I am ordering 2000, my annual cost is just 7128. So which is a better thing? Wherever my costs are less, wherever my total annual costs are minimized, that is the best option for me. So the best option for me is this, 2000. So in that case, I need to accept the discount because it is saving $312. If you minus this from this, you'll get this. So that's how we are going to solve the questions using the discount. Now we'll be beginning with the test your understanding number 7. Water Limited is a retailer of beer barrels. The company has an annual demand of 36750 barrels. So D is given over here. D is my annual demand. The barrel cost 12 each. Price of 1 is also given. Fresh supplies can be obtained immediately, but ordering costs and cost of carriage inwards are 200 per order. So ordering costs, the carriage inwards should be the ordering costs as well. Alright. The annual cost of holding one barrel is estimated to be $1.20. The economic order quantity has been calculated to be 3,500 barrels. The suppliers introduce quantity discount of 2% on orders of at least 5,000 and 2.5% on orders of at least 7,500. So what are we supposed to find out? We are supposed to, just a second. We are supposed to determine whether the least cost order quantity is still the economic order quantity of 3,500 barrels. So we have to find out whether the least cost order quantity, which is the least order quantity which we originally have, is still the economic order quantity of 3,500 units. Alright. So what are we going to do? We are going to find the total annual cost of having 3,500, which was my original, and we are again going to find out my total annual cost with 5,000 barrels, and we will also find with 7,500 barrels. And wherever my total annual cost will be the minimum, the least, that would be my economic order quantity. So I hope you can do it by yourself, but let's still just discuss it. First, let's find out for 3,500 barrels. Let's go to the question and see what all is given. Annual demand is 36750. I hope you're solving it along with me. The barrels cost 12 each. So each is costing $12. Fresh supplies, but ordering costs would be 200 per order. Okay. The annual cost of holding barrel in inventory would be 1.20. That is the holding cost. The economic order quantity is 3,500. Okay. So what is my holding cost? My holding cost is, what is my holding cost? 1.20 multiplied by the average inventory. Average inventory would be the order quantity divided by 2. So by doing this, I'll get 2100. How will I find my order quantity? Order quantity of 1 multiplied by the total number of units, which is annual demand. Just a second. So then it would be annual demand multiplied by the order quantity. So that would be my 36750 by order quantity. That would give me 2100 again. Okay. So my total annual cost would be P multiplied by D. And what is P? P is 12. It's given in the question. P multiplied by D would give me 441000. So my total annual cost is going to be 2,100 plus 2,100 plus 44100. Let me just add that. 2,100 plus 2,100 would be 445200. Okay. So for 3,500 barrels, my total annual cost is going to be this much. What was the next case? The next case was 500 barrels, 5,000 barrels. So for 5,000 barrels, I will do now. Everything else is the same. The suppliers introduce a quantity discount of 2% on orders of at least 5,000 barrels. All right. So how am I going to go about that? First, let me do my ordering cost. What is the cost of one order? 200. We've already read that. 200 multiplied by demand divided by EOQ. Demand divided by economic order quantity, that is 5,000. Okay, this would be my ordering cost. Let me just calculate this. Now let me find the holding cost. My holding cost would be the cost of holding 1 unit is 1.20 multiplied by my average inventory, which would be 5,000 by 2. And that would give me $3,000. Okay. And what is my purchase multiplied by demand? Now, where do I have to apply my quantity discount? My quantity discount will be applied on my purchase cost. So my purchase cost is demand multiplied by price of one item multiplied by 2%. Okay, so how am I going to do that? Just making it simple for you. Okay, my new price is going to be 11.76. So my P into D is going to be 432,180. Now I have to add my holding cost plus my ordering cost plus my annual thing. So my total annual cost will come to this. So this is for 5,000 barrels. Now I'm going to find for 7,500 barrels. Again the same way. My holding cost is going to be average inventory, which is 4,500. My ordering cost would be cost of one order multiplied by my annual demand divided by my order quantity, which would give me 980. And my price was earlier $12. How much discount is given now? 2.5 percent. So what is 2.5% of 12? So 12 minus 0.3 will give me. So what is my P multiplied by D? Okay, now I have to add my ordering cost, holding cost, and my P multiplied by D, and that would give me 435,455. So now I have my 3 annual costs. So go and check this. So it is 445,200 for the first thing, 436,650 for the second, 435,455. Where is the cost minimum? In this third situation. So in that case, you should be opting for 7,500 barrels. I hope that is clear. Now we come to the next concept, which is the gradual replenishment of inventory. So what is replenishment? Replenishment is basically ordering again and refilling my inventory again. Organizations who replenish inventory levels gradually by manufacturing their own products internally also need to calculate the most economical batch size to produce. So what we calculated right now, what we studied right now was the economic order quantity. So that was basically how much units I have to order. Now what we are going to see is what is the economic quantity which we have to produce, how much goods I have to produce. So that is something which we'll be looking into. So here we'll be talking about the units which are ideal to produce. So the divisions faced by organizations that manufacture and store their products involve deciding whether to produce large batches at long intervals or produce small batches at short intervals. An amended EOQ model. Okay, so again this is the same thing. We have to go about it the same way we had with the economic order quantity. So let's just straight away start with our questions. Large or small batches? What do you understand by large or small batches? Do I need to produce a large amount of goods in one go, or do I have to produce them in smaller quantities? Which one is going to be more ideal for my organization? Producing large batches at long intervals will lead to low machine setup cost, as fewer machines will be needed, and high holding costs, high average inventory levels, as more inventory is held. So if I want to produce, every time I have to produce goods, every time I have to manufacture goods, I'll have to keep setting up my machines. But if I produce in one go many goods, then I have to set up my machine once only. But at the same time, when we have a larger quantity of goods, it becomes difficult to store them. Producing small batches at short intervals will lead to high machine setup costs, as more machine setups will be needed, and low holding cost, low average inventory. So there are pros and cons of both of the situations. The EBQ model is primarily concerned with determining the number of items that should be produced in a batch compared to the size of an order within the EOQ. The formula of the EBQ is as follows: 2 cost of order annual demand, cost of holding 1 minus annual demand upon R. Now what is the new thing which we have learnt over here? Again, the meanings of these change in both of the formulas. Here, Q is the batch size. In the EOQ, Q was my order size. D is my annual demand. D stays the same. CH is cost of holding 1 unit for 1 year. Stays the same. CO is not the ordering cost. It is the cost of setting up one batch ready to be produced. And R is my annual replenishment rate. Okay. Let's see my illustration number 5. The following is relevant for item X. Production is at a rate of 5,000 units per week. Okay, it is the rate which is given here, annual rate which is given here. So this is my R. Demand is 10,000 units per annum. So my D is given over here. Evenly spread over 50 working weeks. Setup cost is 2,700 per batch. So the setup cost was my CO. Storage cost is this much. So this is my storage cost. So that is the cost of holding one item in the inventory. Now we just have to find the economic batch quantity. The formula of the EBQ would be given in the question. You just need to put it in the question. So they have just substituted the values and took an under root. You come to 6000. Again check the formula. 2 times, so D is my annual demand, R is my replenishment rate, D is my annual demand. This is the cost of holding 1 unit. CO is my cost of setting up one batch that is ready to be produced. Test your understanding 8. AB Limited makes a component for one of the engines that it builds. It uses on an average 2000 of these components steadily throughout the year. So that is my annual demand. 2000 is my annual demand. So 2000 is my annual demand. The components cost 16 per unit to make. So 16 per unit to make would be the cost of, just a second, we'll come to it. And it costs an additional 320 to set up the production process. So setting up cost is going to be 320. The holding cost is 10% of the unit production cost. 16 is the unit production cost. So how am I going to find this? What is my replenishment rate? Tell me. My replenishment rate is going to be 200 multiplied by 50. Why? The company makes these components at the rate of 200 per week and the factory is open for 50 weeks per annum. So my replenishment rate is going to be per week multiplied by my week. This was the reorder rate. We have studied this in the previous part, right? And what is the cost of setting up one unit? The cost of setting up one unit is 320 given in the question. And what is my holding cost? Holding cost is 10% the production unit cost, which is 1.60. Now in my EBQ, 2COD upon CH1 minus DR, I'm just going to substitute the values and get my answer. And it is going to be 1000 units. Now we come to maximum and minimum inventories. What do you understand by maximum and minimum inventories? Many inventory systems will also incorporate maximum and minimum inventory warning levels, above or below which inventory would not be allowed to rise or fall. So this is having an upper limit as well as a lower limit for the inventory level. In practice, the maximum inventory level is fixed, taking into account. So you take all this into account, and for minimum inventory, you take all this into account. I think you can read it. A simplified method of determining these control levels is by reference to the reorder level, reorder quantity, and estimates of possible lead times and usage rates. So my minimum level is going to be reorder level minus average usage multiplied by average lead time. So what is my minimum level which I need to maintain? My minimum level which I need to maintain would be the reorder level. How much would be my reorder level minus how much I'm average using multiplied by my average lead time. And what about my maximum level? The same way, I'm going to have a reorder level plus reorder quantity. Reorder level and quantity is going to be added in the case of maximum level minus minimum usage multiplied by minimum lead time. So in my maximum level, I'll be using minimum usage and minimum lead time, and in my minimum level, I'll be using average. Let's again quickly try to write the formulas and try to learn it along with me. So my minimum level would be reorder level minus average usage multiplied by my average lead time. Whereas my maximum level is going to be reorder level plus reorder quantity minus minimum usage multiplied by my minimum lead time. So my minimum level will be given by reorder level minus average usage multiplied by average lead time, and my maximum level will be given by reorder level plus reorder quantity minus minimum usage multiplied by my minimum lead time. So if at any time inventories fall below the minimum level, there is a warning that usage or lead time are above average. Thus the storekeeper need to keep an eye on the inventory levels. If inventories rise above the maximum level, the usage or the lead time have actually been lower than the expected minimum. If it is the usage, it may indicate a general decline in the demand for the inventory and the order quantity, and possibly the reorder level should be reviewed. Avoid holding excess inventory with associating holding costs. Control procedures to minimize discrepancies and losses. So what are the control procedures that need to be taken by an organization in order to minimize discrepancies and any sort of losses? The level of investment in inventory and labor costs of handling and recording or controlling them is considerable in many organizations. It is for this reason that organizations must have control procedures in place in order to minimize discrepancies and losses. So the businesses must be having a control procedure. If they will not control, then that might lead to various kinds of losses to the business organization. So the first control procedure is stock taking. So what is stock taking? Stock taking is a process which involves checking the physical quantity of the inventory held on a certain date and then checking this balance against the balance on the store's ledger cards or bin cards. So we are checking the physical quantity, manually checking the physical quantity, and we are going to check this balance against the store ledger cards or store bin cards. Stock taking can be carried out on a periodic or a continuous basis. So now what is a periodic stock taking? Periodic stock taking is involving checking the balance of every item on the same date. Usually it will be at the end of the accounting period, and that is carried out on a particular date every year at the same time. What is continuous stock taking? Continuous stock taking involves counting and valuing selected items on a rotating basis. So specialist teams count and check certain items of inventory on each day. Each item is checked at least once a year, with valuable items checked more frequently. So it is done on a rotation basis, and continuous is done more frequently than our periodic stock taking. So stock taking is basically just physically counting how many goods we have and trying to compare it with our store bin cards. Any differences which arise between book inventory and physical inventory must be investigated. In theory, any differences as recorded in the store's ledger or the bin card must have arisen through faulty recording. Once the discrepancy has been identified, the store ledger card is adjusted in order that it reflects the true physical inventory. So whatever discrepancies occur, you need to take a note of it and rectify it as soon as you realize it. Any items which are identified as slow moving or obsolete, that means something which is not getting sold, should be brought to attention of the management as soon as possible. Management will then decide whether these items should be disposed and written off to the statement of P&L. Slow moving items are those inventory items which take a long time to be used up. Obsolete items are those items which have become out of date and are no longer required. So what are my examples of other issues and controls? Issue: ordering goods at an inflated prices. So this can be a particular issue, right? That you have ordered the goods at a high price or at an inflated price. In such situations, we need to use standard costs for purchases, quotation for special items, which means we should buy goods at the standard costing only. Fictitious purchases. You recall what fictitious assets were? We have done that in the F1. So we need to separation of ordering and purchasing, physical controls over materials. Shortages on receipts, checking in goods inwards at gate, delivery, signatures. So all that can be done. Losses from inventory, regular stock taking, physical security procedures. Writing off the goods, write off. Losses after issue to production, records of all issues, standard usage allowance. So these are the types of control procedures which are going to be taken into account in these sorts of issues. Okay, inventory losses and waste. Inventory losses may be quantified by comparing the physical quantity of an item held with the balance quantity recorded on the bin card. So you can just take a look at this. We've anyway discussed this. It's related to the inventory losses. Suppose that a 100-meter length of copper is bought for $99. The estimated loss caused by cutting into shorter lengths is 1%. The issue price could be based on expected issues of 90 meters, 1 per meter, rather than pricing the copper at issue price 99 divided by 100. So you need to take in account the losses which might happen. So I'm ending this video over here. In the next part, we will be finishing with the chapter. The next part would be the last part of this chapter, where we'll be seeing valuing inventory. Even though we have done this portion in your F3, you have done it in your F3, you know what FIFO method is, you know what EVCO method is, but we will still be discussing it all over again in the next part, and then we'll be done with this chapter. So let's just quickly revise our formulas. Okay, so we have our economic order quantity, and we also saw my economic batch production quantity, where my D is my annual demand, R is my replenishment rate, CH is my holding cost, CO is my cost of setting up one batch of production. And what was my reorder level formulas? Let me quickly go there. Okay, my minimum level would be reorder level minus average usage multiplied by average lead time, whereas my maximum level would be reorder level plus reorder quantity minus minimum usage multiplied by minimum lead time. So in case you would like to watch another chapters, the rest of the chapters, or you would like to solve the captain exam kit, then I have linked it in the description box below. Thank you.